As Jen says, today I'll be looking over the requirements for business valuations in financial statements. I'll be looking at three key areas: purchase price allocation reports, impairment reviews, and share-based payments. You'll have heard a couple of those areas already pop up in previous talks. So when relevant, these elements are key for finance directors to understand and manage so they can significantly impact a company's financial health and financial statements, and if not properly undertaken, can lead to issues with the audit or during any sale due diligence. The three areas I'm going to cover, for each of the three areas, I'm hoping to look at when you might need them, what each is, the importance of each, the overall approach to our valuation, though I think I'll skip some detail in there, and an outline of some of the challenges and opportunities arising. While many valuations are based on profit multiples, it was very interesting hearing what Phil said about inflation rates, as all three scenarios actually rely in part on the risk-free rate, which is closely linked to the rate of inflation. However, to some degree, expected changes are already reflected in risk-free data, so we didn't expect and we didn't see risk-free rates hit 10% when they peaked as they did in Phil's graph. It's the unexpected change that brings valuation differences. So let's move on to our first slide, really. We start with the purchase price allocation exercise. These are typically required on an acquisition of one business by another or during certain group restructurings, but they're not applicable to certain investment entities as defined by certain standards. I've put a definition on screen. There are numerous ones around, and I'll let you read through it. But maybe while this stays on, I'll just skip on to the next couple of points so you can read through. Why are they important? Well, firstly, they ensure that the financial statements reflect the true value of the acquired assets and liabilities on acquisition. They also assist with comparability between the financial statements. Secondly, sorry, Peter, they are necessary for the dreaded audit. And finally, in the event of an asset sale, they can benefit for tax purposes as the amortization of certain intangible assets can, in the right circumstance, qualify for tax relief. Let's move on to the next slide now then. But what are they? By way of a quick example, imagine a company acquires another with one real asset in it, a contract with its one customer. The acquisition price will inevitably be reflective of that contract value. The PPA exercise ascribes value to that contract by looking at its profitability, risk profile, and term. Now imagine a different business servicing thousands of small customers with no contracts. What brings those customers in? Is it their brand? Is it the technology being sold? And under the accounting standards, how do we value and recognize it? Well, IFRS 3 sets out the 4 steps. If we can move on to the next slide now, please. The first step is to identify the acquirer. This is usually a given. And then we identify the acquisition date. Also normally obvious, but not always the SPA date. The complicated bits come in the recognition and measurement of the identifiable assets acquired, the liabilities assumed, and any non-controlling interests in the target. We're often involved in relation to the instruction for the valuation of material intangible assets, such as brand, technology, or customer relationships. The final step is the difference between the identified assets, including intangible assets, and the purchase price, which generates the goodwill on an acquisition, or on a bargain purchase, the negative goodwill, or as I saw in one report recently, badwill. As shown on my next slide, PPAs can be incredibly complex, and I set out on screen some of the key considerations we must make. I'll pick up on one or two of these, but by no means all of them. So what intangible assets are identifiable? The actual recognition criteria differ between FRS 102 and IFRS, but in essence, recognition criteria include the materiality of the asset being income generating, its value being measurable, and if the asset is separable and or contract based. Typically, the areas, as I've said, that we get involved with are brand, customer relationships, and technology. But other revaluations that need to occur as part of the PPA process would include property, inventories, and all sorts of other assets and liabilities. So what is the correct methodology to be adopted? Well, particularly in the intangible asset arena, there are so many different types of assets, and there are so many different types of methodologies. We select ours based on the international valuation standards, dependent on the type of asset being generated. But most, are built around a discounted cash flow model. So there are some opportunities here. The recognition of intangible assets that may qualify for tax deduction on amortization can be a very strong point. The presentation of a stronger balance sheet for the company with less reliance on goodwill and perhaps more stronger intangible assets such as customer relationships and technology. Or conversely, under FRS 102, there is an opportunity for intangible assets not to be recognised where they might otherwise have been recognised under IFRS 3. However, they do still need to be considered. In my next slide, I start to consider impairment reviews. As Peter mentioned, impairment is the number one issue that's been identified by the FRC, so it's clearly under the microscope. But I also saw on their list that at number 2 was judgments, as most valuations are, and at number 10 was fair value measurement. Impairment reviews are necessary where a business identifies indicators of an impairment. This might be as simple as an interest rate increase, which causes the costs of a division to spiral, or it might be the payment of a dividend from a subsidiary up to its parent that eradicate the value of the subsidiary. We have to be careful in this area, and you need to keep your eyes open for these indicators. Again, I've put a definition on screen, which I'll let you read through. But what is the importance of an impairment review? One point raised is asset valuation accuracy, or, as valuations aren't always accurate, at least reasonableness. And another point is investor confidence. Often this is the existing shareholder, but it can be potential acquirers, debt funders, and even other stakeholders such as employees, customers, and suppliers. So what is an impairment review? Many businesses have built up certain types of assets on their balance sheet that arise from investment or project expenditure that's been capitalized. Often carrying values are set based on a market transaction at the date of inception. However, if circumstances change, the market value of these investments may decline below the carrying value, even if that carrying value is being amortized. In such circumstances, the standards require the carrying value of the investment or expenditure to be impaired. We must therefore ascertain the market value and/or value in use of such assets. So on the next slide, I've set out the steps within the accounting standards. Previous slide now. The first step is we must identify the business's CGUs. These are the cash generating units. Next, we ascertain the fair value and the value in use of each CGU. From these, we can calculate the recoverable value, which is the higher of the above. And hence, if measuring only one suffices, we don't need to measure both. And finally, we recognize or reverse any impairment loss. And now on to my next slide. Again, I put up a number of considerations here. We'll pick up just one at this stage. The most important thing here is to identify the cash generating units. Simplistically, the cash generating unit is a part of the business which has separable cash flows that can be identified and has a separate cost that needs to be assessed. So in my last section, and I apologize, I'm flying through these, I consider share-based valuations. As mentioned by Sam, share schemes and growth shares are becoming more popular in the right circumstances. Again, I've put a definition up on screen, but she's already been through that, so we can move straight on. These are important as they align the interests of employees with those of shareholders, promoting motivation, retention, and drive value growth within your business. They also ensure the better recognition of cost of employing staff than would otherwise be included. And finally, it goes without saying, it's satisfying those auditors again. The steps from IFRS 2 are we have to recognize the need for these, and I'll come back to that shortly. We then ascertain the value of the underlying share. If required, we derive the value of any option. So options obviously are different from shares. And the standard even defines the necessary steps in looking at the option. We must consider things such as the current share price, volatility, dividends, and the risk-free rate. And finally, we release the expected total charge over the expected vesting period. And on my very last slide, I've summarized some of the key conditions again. The only one I'll highlight on this occasion is that the most common error we see is that because there's been no cash transactions, the options have not been accounted for at all. So even if there is nothing changing hands, please get in touch with your usual KR contact and we can discuss it.